Hey, what's up, everybody? Welcome back to the channel. So the topic of today's video is going to be solar energy stocks, specifically looking at one company that's been getting a lot of attention recently, which is Enphase Energy. So the first thing that I want to do in this video is I want to give a quick overview of the solar energy market as a whole by explaining a few important things, which are how the whole supply chain of the solar energy market works as a whole, who the major players are at each level of that supply chain, and then also what key trends should investors in this space be aware of? So specifically looking at Enphase there. And then as always, I'm going to conclude this video by doing an actual discounted cash flow valuation of Enphase Energy with the goal of trying to determine at their current price today, are they overvalued or are they undervalued? So one thing I want to preface this whole discussion with is just by saying that Enphase and really solar energy stocks as a whole are, they're energy companies, right? And energy is a very politically charged industry, which means the sector is very heavily influenced by regulations. So the industry dynamics that you see are not just purely up to supply and demand, they're also up to regulations that get enacted that then influence supply and demand, which can be very, very unpredictable, right? It's difficult to predict what regulations get enacted. So, looking at this industry to start, I want to kind of mention what the real draw to solar energy from a consumer's perspective is. And this chart does a good job capturing that. So we can see this represents the cost of various forms of energy over time, going from 2020 back to 2009. And this is from a blog called Visual Capitalist. And we can see that solar energy is the one that has had the most significant change. It's down from 359 on a dollars per megawatt hour basis, down to now where it's currently actually the cheapest source at just $37. So 90% reduction over the last, or over the 11-year time span here. So as a result, what we've seen from there is solar installations, specifically in the US, because the US is a massive solar market, although a lot of the companies in a lot of the publicly listed solar companies and Enphase as well, they have international operations, but just looking at the US here, we can see pretty much over the last 7 years, solar installations, residential and commercial, have exploded, right? This is becoming a huge industry now. A lot of new jobs are being created in this industry. And that kind of begs the question, at least for me, it did, why is that happening, right? How did this industry become so massive over just a span of a couple of years? Really, in the last decade, this whole industry became as big as it was. People knew about solar, 10 years ago, but really it's become a massive industry and it keeps growing. So how did this happen? Well, really, a big reason why this happened was because of government programs. And again, we're specifically looking at the US here, but it's pretty much the same across a lot of Western economies. They all had some sort of government programs that were looking to encourage solar installations. So, and there's a few different ways they did this. There's a whole bunch of different regulations, but I highlighted the three main ones here. So one is the investment tax credit, or ITC. So this kind of targets the consumer level, where the people who are actually installing the solar panels, whether it's an individual at their house or if it's a company that wants to have access to the solar energy grid as their energy source. So it was originally enacted in 2006 and it was a federal tax credit. So it's basically just, you install solar panels or you connect to the solar energy grid, you can reduce your taxable income, whether you're an individual or if you're a business. And this tax credit, there was a question about a year ago whether or not this was going to, not exist anymore. But in the Inflation Reduction Act, which was enacted in, I think, August of last year, it allows homeowners to deduct 30% of the cost of installing residential solar systems from their federal taxes. So that's a huge incentive, right? And that targets the consumer level by reducing the cost of solar energy, which allows people to save money and it encourages them to adopt solar, right? And that's what governments do, right? They use tax laws to influence people and have certain behaviors that they want to start seeing. So that's the consumer side. They also targeted the producer side because that, it's going to stimulate demand, but you also have to stimulate supply. So then there was this producer tax credit, which again, looking at the Inflation Reduction Act, there was a new, what they called a Advanced Manufacturing Production Tax Credit, or AMPTC, on a device called microinverters, which is what Enphase actually manufactures. That's how they make their money, which when we dive into the supply chain, I'll talk more about that. but this was specifically for them and it's 11 cents per watt. So again, this is just encouraging people, manufacturers specifically, to actually start producing these things and get more solar energy out there. And then another one is called net metering. So net metering, it allows people who have access to the solar energy grid to receive credit for any excess electricity that they have. So if they don't use all of the solar energy that they generate, they can send it back to the grid and they get a prescribed amount of dollars for that amount. And then in California, so this is a recent development that occurred in California where this actually got reduced quite a lot, the amount of money that you receive for sending solar energy back to the grid. It was previously 25 to 30 cents per kilowatt hour. Now it's gone down to 5 to 8 cents. So that's one of the reasons why, if we go back to the stock chart here, why you're seeing solar energy stocks, specifically Enphase, decline so much fairly recently, right? It's because of this regulation, which is going to, well, really what it does is it makes it more expensive to actually adopt these technologies for consumers because, I mean, sure, with, solar energy, there's always a environmentally friendly aspect of, adopting this technology and using it. But the reality is, for most consumers, they make decisions based on cost, right? Some people may make decisions based on, what's good for the environment, but most people will make decisions based on what is the cheapest. And by having this change here, it kind of reduces the cost effectiveness of installing solar panels because if they do decide to, send some excess electricity back to the grid, they're not getting as much money for it, which means the payback period of installing solar energy is going to take a bit longer and it's not quite as cost effective. So that's a pretty important development. And really what the impact for Enphase is just in general reduced demand for solar energies, which is reduced demand for these micro inverters that they manufacture. And this is just specifically in California, but California in the US is a significant market. It's the largest, on a state level, it's the largest solar energy market. Okay, so next we're going to look at the supply chain of solar energy. So I've listed off a few of the large solar energy companies that are currently publicly traded, and I've slotted them into different categories of each of the stages in the supply chain. Now, keep in mind, pretty much all these companies are diversified in some way, and they're going to operate in several areas of the supply chain, but I put them in the specific area that they are most well known for. So the start is solar cell manufacturing. So this is just simply the actual cells that collect the solar energy. And a company that's well known in this space is First Solar. And I believe First Solar is actually the largest, at present time, the largest publicly traded solar company. Next, you have module manufacturing. So this involves combining these solar cells into one structural unit, which is basically just a solar panel. And that can then be installed. It can be connected to an electricity grid. And one company that's well known here is Canadian Solar. So then you have to actually convert the electric current that is generated into a different type of electric current that can be used to power devices, right? Like appliances and basically just power a home. Or at whichever property that it's trying to power. So there's two different devices. One is microinverters, which, as I said before, is what Enphase specifically specializes in. And then there's also string inverters, which is what SolarEdge does. So again, these are two large companies in this space, and I'm not going to dive too deep into the specifics of which technology is better and the pros and cons of each one. But basically, what's important to know is there's two different options that you have for, actually converting the current. It can be a microinverter or a string inverter, and these companies do different things. So then there is the storage of the solar energy, and Tesla is actually a very large player in this space. Now, Tesla as a company as a whole is a massive company. They obviously have a huge car business as well. So their solar energy storage business is pretty small relative to the business as a whole. But it's still a large business, all things considered. You're talking multiple billions of dollars in revenue for their, solar storage business. So they are a key player in that area. And this does, they use lithium ion batteries to basically just store excess solar energy. So when there's periods of lower sunlight, then you can still actually, have some energy produced. And then there is the installation. So this involves working directly with the consumer, whether it's commercial or residential, to install these solar panels. And one company that's well known here is a company called Sunrun, which I actually did make a video about this company a few months ago where I was talking about a short report that got released on this company where Basically, there was a short seller that was accusing Sunrun of manipulating their non-GAAP metrics and presenting very favorable metrics that didn't actually have any substance behind them. But that's a whole other story. And specifically here looking at Enphase, as this is a company that I'm sure most of you are interested in, this company does stand out when you first look at some pretty basic metrics about this company. So I'm going to open up the tables feature here, and then I'm going to open up this table, which is basically a comps table of profitability metrics for pretty much all the companies that I just looked at. And here's Enphase at the top here, and we can see across the board, across all profitability metrics, they stand out quite a lot. They have the highest gross profit margin by a slight amount over First Solar, but they have the significantly highest operating margin. And this is as of the last 12 months of financials that they've reported at 22%. The next highest is Canadian Solar at 6%. So they are significantly the most profitable company, and then their net profit margin is 20%, right? So that's obviously very good as well. So I think that's why this company really stands out, because the unit economics of Enphase is extremely favorable. And if you're looking at all companies that exist within a supply chain, the company that is able to achieve the widest profit margins is usually the companies that are providing the most value, right? That's kind of how that works overall. And by the way, if you're wondering what this website is that I'm using here, it's called tickernomics.com. This is a website that I created for myself and I've now released to pretty much anyone on the internet who wants to access it. And it has data on tens of thousands of companies. So if you want to use this website, explore around and do your own research, feel free to do so. I'll leave a link in the description. The website is currently, it's free to use. So feel free to do that if you are interested. Okay, so now that we have that background, let's dive into some key trends that are impacting Enphase specifically. So I want to go actually back to the stock price chart just so we have some history on what this has done over the past few years. So we can see pretty much leading into the midway point of 2022, this thing went up like a rocket and then it subsequently crashed pretty significantly. And whenever you see a movement that is this drastic over a period of, say, 5 years, you can pretty much chalk it up to a multitude of factors, and you can classify those factors as either macro level factors that are impacting the industry as a whole and maybe even impacting some other industries, and micro level factors that impact Enphase specifically. And in this case, you do get a little bit of both. So that's what I want to talk about now. So at the macro level, what has really weighed down on this company in pretty much the last year is predictably it has to do with interest rates, right? Higher interest rates. So because solar panel installation projects are what ultimately drive the demand for the microinverters that Enphase produces, and these projects are typically going to be financed using debt, higher rates just simply make them more expensive. And then something else at the macro level that has occurred has to do with the war in Ukraine, actually. So, what happened was at the onset of the war, you saw this initial spike in demand for solar energy because other sources of energy got a lot more expensive, specifically in Europe. And this is basically what the company is talking about here. There was a one-time surge in sales that was related to the onset of this war, but this has since subsided. So now you're starting to see a flow through in less demand for these microinverters because, energy costs have come down since then, and pretty much that whole energy crisis that could have taken place in Europe was largely averted, although it was, not an ideal situation for sure. Um, Now, something else that has occurred in the last quarter, which is something I did already talk about, was this net metering, right? So just to re-summarize this, basically you saw a significant reduction in the revenue that customers can earn by sending electricity that they don't use back to the grid, and it went down from 25 cents to 35 cents per kilowatt hour to 5 to 8 cents, right? So that, it just makes in general installing solar energy not as cost effective as it once was. And this materially changes the business, right? Because this is a permanent change. And unless you foresaw this happening, say 8 months ago, if you initially invested in this company, you're going to have to revise your assumptions going forward in response to this. And this really just highlights what I was talking about before, which is when you're investing in such a heavily regulated industry, you pretty much have to accept that this type of stuff is going to happen, and you have to account for this type of risk in your investing because it will happen at some point. But sometimes regulation can be favorable, it can work in your favor, but in this case things didn't quite work out that way. So because of all those factors I just talked about, basically what Enphase guided in their most recent quarterly report was revenue. If I open up the income statement here on a quarterly basis, revenue for Q4 of 2023 is going to be between 300 to 350 million dollars, right? Now, how Enphase works is they sell their micro inverters through distributors, right? So these distributors are going to have their own inventory levels that if they're not selling them to end customers, those inventory levels are going to build up quite a lot. And if they do build up quite a lot, then they're not going to order additional ones from Enphase, right? That's again, that's kind of the whole the supply chain of that. So it's a pretty significant decline in revenue. I mean, they were doing for 3 quarters here, they're doing over 700 million in revenue per quarter. And again, extremely profitable at that, 20% plus operating margin across the board, or at least going back into Q3 22 here. So very good unit economics in that. And as I showed before, the most profitable solar energy company that you can currently invest in on the market. But the question really becomes, what is demand going to look like going forward? How many more quarters of, say, 300 million revenue are we going to see with Enphase? That's one question I see a lot of investors asking. But what I think is the more important question is to take a more long-term view, right? What does the demand for solar energy look like 5 years in the future, or 10 years in the future? And it's going to be influenced by, it's going to depend on a lot of things, right? Like I said, there's the regulation that gets enacted, the cost of other forms of energy. Like if other forms of energy continue to be very expensive, naturally that's going to induce more people to get interested in solar and learn about solar, and even consumer taste to some extent, right? Because it is kind of a consumer purchasing decision at the residential level for whether you want to have solar energy or not. If it just becomes more popular, people will just feel okay, they'll feel more okay going with it, right? In general, I see the future for solar as quite favorable. Now, obviously, I'm not an expert on this. This is just my own opinion, so take it for what it's worth. But I think in general, we're seeing a pretty strong push, specifically in Western economies, to move more towards clean and renewable sources of energy, right? And also, it's going to depend on the future cost of energy sources, and that's going to be very difficult to predict, as well as the regulation. So you could see this, in my opinion, this is a very risky industry to be invested in, but I do expect it to be favorable going forward. Okay, so now the last thing we're going to do is, as promised, do that DCF valuation. And for this, I'm going to use the value of stock feature in Tickernomics, which for this, we just enter a company that we want to value, which is Enphase, and it's going to load some data for us. And then the next thing we can do is we can select how many years we want to include in this DCF model, which I'll just leave this as 5 because that's a pretty standard one. And our assumptions are all going to be entered here, and this just gets automatically populated based on the historical 5-year averages, but obviously these are going to change going forward. So what I want to start first with doing is trying to figure out what are some reasonable assumptions, and then how can we just adjust those assumptions slightly until we get to a point where the company is about fairly valued, because then we know what investors collectively as a whole are expecting Enphase to do pretty much over the next 5 years. And really, the three assumptions that have a significant influence on the resulting valuation is going to be revenue growth, operating margin, and then what we have as our terminal multiple. So for revenue growth, I'm just going to revise this down currently to 15%. So that's 15% per year for the next 5 years. The operating margin, it's a bit higher recently than it has been in the past. So I'll revise this to 22%, which is pretty much in line with what it's been the past few quarters. Now, the tax rate, they've historically had a low tax rate because they were losing money for a while and they were able to use loss carry forwards and then also tax credits that they get for being a clean energy company. But they mentioned in their most recent earnings call that that's not going to be the case anymore, and they're basically going to be paying tax in line with what most normal companies would, which for this I'll put about 18%. Now, capital expenditures, it's difficult to predict this going forward because this kind of depends on what years they decide to expand their manufacturing. It's tough to tell what that's going to be for the next 5 years, but we can get a general idea of what it will be on a year-over-year basis. And we are expecting their revenue to grow pretty significantly. And the way that revenue is going to grow is by expanding their manufacturing capabilities, which will require CapEx. So for this, $130 million per year seems about reasonable going forward. And then as a result, their depreciation amortization is going to increase as well. So I'll go 80 with that. Now they are going to have to also purchase, parts and inventory in order to actually, produce the goods that they sell to people. So for this, I'm going to have about $50 million in working capital investments that they have to make per year. The shares I'm just going to change to zero because this ultimately doesn't influence our current valuation, and then the cash and debt totals I'll just leave the same. So the system also automatically calculates cost of capital, which seems reasonable at about 9.4%. So what do we want to use for our terminal EBITDA multiples? So I'll open up this, which this just allows us to compare multiples across different companies that are also in the solar energy space. And if we look at the multiple we're using, which is EV EBITDA, we can see what it is for Enphase, which is around 20. That seems pretty high. This multiple will probably contract going into the future years. Um, so, we can see for some companies, it's going to vary quite a lot depending at which stage, growth stage each company is at. But there's some that are a bit lower, right? We can see 13 here, 10 here. There's a few companies that are kind of in the 20 range as well. But what I'm going to use for this is something that's on more of the conservative side, which is 12 and a half, right? So let's just input these numbers, hit calculate the DCF, and see what we get. So we're pretty much bang on with the intrinsic value here at 97, about 98 per share, whereas the current price is about 99. So pretty much from this, we can assume that investors as a whole are collectively assuming that they're going to do 15% per year in revenue, 22% operating margin per year for the next 5 years, all this other stuff. And then at the end of 5 years, they will be selling at a enterprise value to EBITDA multiple of about 12 and a half. So I think that, that's reasonable overall. Now, in terms of what I actually think will happen, there's a few scenarios that we can look at, right? There's a base case, there is a bear case, and then a bull case. Because, like I said, this all kind of depends on the regulation, what happens with interest rates. If the United States starts cutting interest rates and, European countries start cutting interest rates, you could see demand pick up pretty significantly, right? Because now solar becomes cheaper. So let's say in our base case, interest rates, they stay high for about 1 to 2 more years, and then they begin to decline after that. And the regulation that's enacted remains pretty much unchanged from what's currently in place. So let's say our revenue over the next year will be about $2.5 billion and then 20% annual growth after that. Operating margin 22%, and keep it the same. CapEx is a bit higher, depreciation, amortization a bit higher, and then we'll keep the same exit multiple. So we'll go here. We'll say CapEx is about 140, depreciation amortization is 100. We'll leave everything else the same, operating margin the same. We'll change this to 20% revenue growth for a year. So we're going to get, a more favorable estimate here. So $118. Now, one thing I also want to quickly change is we're saying the revenue over the next 12 months will be a bit lower because as we already proved, the company is facing some headwinds. So if I open up details here, I can edit the numbers directly, and it doesn't really influence that much. It really only went down $1 there. Okay, so that's the base case. Now let's look at the bear case, right? So what if revenue only grows by say 10%? So we'll change this to 10%. And in this scenario, we're saying interest rates remain higher for longer. So say they remain elevated for the next 4 to 5 years, but the regulation, remains pretty much unchanged. So you're going to see this short-term demand drop from the net metering regulations, but also over the next 5 years, the demand is being weighed down by these higher rates. So 10% annual growth, operating margin, because their revenue growth is a bit lower, we'll just revise this down slightly. And then CapEx, we'll say CapEx, they have to invest a bit more in CapEx in order to achieve this revenue growth because they just have to up their manufacturing capabilities. We see a bit more in depreciation, amortization, and then a lower exit multiple. Okay, so we'll change this to 10. And then, so we'll change this to 175. And then this we can change to about 110 per year. We'll go 120. That seems more in line. And then we'll calculate that. And so under this scenario, it's a lot worse, right? So I guess if you believe that bear case, then obviously you would not be interested in this company. Now, what's a reasonable bull case, right? Now, let's say interest rates, they stay high for a bit longer, but then they begin to decline, and then regulation just becomes more supportive on a global scale. And then also say other energy sources become increasingly expensive, so more people get interested in solar, right? So let's say revenue growth is now 30% per year for the next 5 years. We'll say 23% operating margin, CapEx 125 million. So we'll change that to 125 million. Depreciation and amortization, we'll say 90 million. Change this to 125. And then we have a 14 times exit multiple. So the exit multiple really influences the valuation quite a lot. So we'll calculate that. Now you're looking at a very favorable scenario, right? If you believe these assumptions here, then Enphase is definitely a company you're going to be looking at because we're basically proving here that the company is worth, say, 55 or so percent of what your estimate of intrinsic value is. So that was pretty detailed what I just did there. But the reason I went through all that is because I want to show you guys a good way to how you can think about companies, right? Because it's good to think of companies in multiple scenarios because you have to recognize that you don't know what's going to happen in the future, especially in an industry like this. You don't know what's going to happen. So you have to do multiple scenarios, like a bull case, a base case, and a bear case, and then see what the valuation is under each scenario. Because then in the future, as events unfold, you can compare what you thought was going to happen to what actually happened, and you have, this objective analysis that you can refer back to that explains how you should think about whether or not you should sell the company, if you have losses, if you should cut those losses and move on, or if it's still undervalued and you should continue to hold on to it, right? So that's my thinking in related to this. So I hope you did find this useful and you got some value from this. If you did, then drop a like on this video and share it with someone who you think would find this useful, and I will see you guys in the next video.